Hello traders, Gary Wagner here, approximately 10:30 a.m. in Honolulu, Hawaii. It is the last day of the month, last day of the quarter, the 30th of September, and the last day of the week, Friday. This is the daily report for gold, our weekend review. This week can be characterized with two words: one, consolidation, and second, volatility. The market is currently up about $7, as you can see, trading basis spot at 1622.90, and basis the COMEX contract, the December contract, is currently trading at 1624.90. And as I said, that puts it up about $7 on the day. Now, the one market that we have been focusing on all this week has been the dollar index. And as the dollar has been gaining in strength, we have been seeing a weakness in the underlying precious metals markets themselves. As you can see, currently trading at 79.29. But more importantly, it is just trading off of the highs of this last week, and you can see that since September, this market, meaning the dollar index, has been noticeably stronger. Traders, we are looking at a 240-minute straight candlestick chart. Each bar or candle represents 4 hours in trading. And the reason for looking at this chart this morning is the fact that since, or should I say through the week, of course, Sunday was the basic meltdown in which we saw this market trade to 1532. But what you can see here is really what I believe to be some strong support or a double bottom that we have formed at 1580. As you can see, on a couple of attempts, it has gone to this area as it came down. The lows hit that 1580, but the open and closes, meaning the body of the candles, were well above that. Good support there. Market comes back up, trades to about a high of 1660 to 1680 right in here. And as you can see, when it came back down, of course, what we saw was once again this market finding support down at 1580. So we've had two occasions where we've seen the market go there. Now, over this last, let's call it 24 to 48 hours, you've seen that it's traded in a very narrow range, in a fairly defined range. 1640 on the upside in terms of a high tick. You can see that that print right here. And in terms of the low, right around 1610, and you can see that right there. Other than that, we've had a market which can be best expressed as a consolidating market. And the one thing that does appear to be forming, of course, is once again this pennant formation. Now, the basic idea with a pennant formation is as that range narrows, in other words, the market comes down, and as the range narrows, as we go towards the apex of this pennant, typically it will break in the direction of the trend, the prevalent trend itself. Since what we're witnessing, since this top here is a basic zigzag or A, B, C correction, the prevalent direction or prevalent trend right now is in a corrective stage of a bull market, meaning down. So the reason for me being hesitant about taking a position over the last couple of days is because I believe there is a likelihood that we might see this market, in fact, trade a little bit lower as it approaches the apex of the pennant. Traders, we are looking at a daily chart in basic candlestick format, and this is showing us, in essence, this entire last impulse, cycle, and phase. As you can see, starting from this end of the corrective stage, this is back in January of this year, we had wave 1, 2, 3, long wave 4, and a tremendous wave 5 that came in. That brought us into our corrective phase, and that corrective phase itself can be best characterized as what we call a standard or classic zigzag, which is A, B, and C. And as you can see, our C took us, in terms of the retracement itself, took us 61% of the gains that we have seen from January of this year, meaning a price point at 1310 all the way up to 1911, and we gave up roughly 61% of that when the market traded to 1539. Of course, it is well off of those lows now, and my belief is that we have been forming a base in this consolidation area at around the 1610 area, and to me that's a very important area because that's a 50% retracement of this entire move. So my belief right now is as follows: if we can form a base here, and that's really what I'm trying to determine right now, because we see some good activity in terms of the candle size themselves. You can see they're rather small, but they are forming a classic three-river morning star variation. I am seeing, though, is that this last candle, meaning today's trading range, we are not closing anywhere off the highs itself, and for that reason it is not as strong as I would like to see, and that is my reason for sitting on the sidelines until we see a break one way or the other at the beginning of next week. This has been Gary Wagner, wishing you as always good trading. We'll talk to you on Monday for another daily update and review. Bye-bye.